Welcome to the Overberg Asset Management Market Review. In this episode, Nick Downing and Gielie Fourie shares with us the highlights of the markets, both globally and in South Africa. If you find this video helpful, please press the like button and don't forget to subscribe to see our upcoming market reviews.
Good day and welcome. I am Nick from the Overberg Greyton office. We are glad that you can join us. Today we are looking at the developments globally, if there have been any changes and how they might influence the markets. So we're starting off here with MRB Partners. I quote, "The markets will remain volatile until conditions in the Ukraine calm, but the global economic expansion will stay broadly on track in the year ahead." What about commodities? We all know that commodities have rocketed. They are appealing hedges against near-term geopolitical risks, but they are also not very appealing investments on a longer-term horizon. And in the meantime, we've got a peak in global manufacturing PMI, which underscores a potential decline in industrial demand for commodities. Edison, they talk about a spike in energy prices, raising the spectre of increased upward pressure on inflation, but at the same time, of course, rising oil prices will affect economic growth. So that creates a bit of a conundrum for central banks. And one of the themes that all the analysts are coming up with is that maybe central banks, although they'll continue or remain on course to tighten and normalize interest rates, there certainly will be a tendency for caution in that regard. Edison nonetheless concurs with the central bank's expectations for materially reduced inflationary pressure by the second half of 2022, even if there are likely to be some uncomfortably high inflation readings in coming months. And of course, inflation is always year on year. We get month on month inflation, but the big headline inflation reading is year on year. We maintain a neutral view on equities. There remains a long tail of sectors, and I would add here markets outside the United States that are set to benefit from a continued economic and corporate profits expansion, and which currently trade only a little above long-term valuation averages. We note that long-term inflation expectations remain well contained, and central banks may yet face a rather different set of economic parameters later in the year, with both economic momentum and inflation pressure easing. Safra Saracen, global economy in general. The pace of monetary tightening in the US and the UK is likely to moderate in the second half of the year and beyond. And they cite three reasons. The first one is COVID is rapidly on its way to becoming endemic rather than pandemic. What does this mean? Demand and supply imbalances should normalize. As a result, inflation rates, both in the US and the UK, should come down quite rapidly from the second quarter onwards. Moreover, imbalances in the labour market should shrink too. Second reason, the sensitivity of inflation to international energy prices is significant. Therefore, if prices were just to stabilize at current high levels, even on a permanent basis, their direct impact on inflation would eventually dissipate. If oil prices, energy prices were to fall in line with futures prices, and here just to elaborate, there's considerable backwardation in the energy market, which means to say futures prices are in some cases 30% below spot prices. So in other words, if prices were to fall in line with futures prices, then headline inflation would move rapidly downwards towards 2%. The third reason why monetary policy is likely to tighten more gradually from the second half onwards is that there is still considerable amount of uncertainty about where the neutral interest rate setting actually lies. The neutral interest rate is where it's neither stimulative nor contractionary. And nobody quite knows where that neutral rate is right now, not even the central banks. A quick look at emerging markets. So traditionally, when global financial conditions tighten, it's bad news for emerging markets. It certainly was in 2013. The outlook at the moment is considerably brighter from the point of view of emerging markets. Most emerging markets have a stronger external position today, with lower current account deficits and better reserves. In South Africa, it's actually, for the first time in many, many years, a current account surplus. Many countries, such as South Africa, are benefiting hugely from elevated commodity prices. What is Safra Sarasin's forecast for the S&P 500? This is an all-important question, since the S&P 500 is over 50% of the global equity index. A more moderate growth, yet a stable macro background in the second half of the year should help equity markets enjoy some upside by year end. The favorite region is emerging markets. They're particularly encouraged by the Chinese economic cycle. According to this analyst, China's economic cycle is due to accelerate, and that is a view mirrored by other research that we have. Interesting, the head of asset allocation says that long-term bond yields, after soaring in January, still don't offer very good value for investors because real interest rates are still deeply in negative territory. Moving on to MRB, global economy and China. We quote here a sizable relief rally in equities and to a lesser extent credit markets will develop should the war-related concerns crest. Chinese stimulus will push its growth rate above trend in 2022 and provide support to the global economic expansion. It must be remembered that the war erupted when the global economy had both solid momentum and with the strongest underlying foundations since well before the 2008 crisis. Financial market indicators show that a significant slowdown in global growth is already discounted. Global equities should have meaningful upside on a 6 to 12-month horizon. The US and Euro area economies have much greater buffers than during previous price spikes or energy price spikes. That means to say higher savings, stronger income growth, better balance sheets. In terms of China, so last week in China was the annual two sessions policy meeting in Beijing, offering very strong hints of further economic stimulus in 2022. They're looking at tax cuts amounting to 2% of GDP. It's considerable. China has been trimming taxes and fees for several consecutive years. This is by far the biggest tax cut yet. And it's quite surprisingly strong, the GDP target that the Chinese government established, 5.5% for 2022. In terms of further monetary easing, the probability is very high. Chinese growth will be accelerating during the course of 2022. Moving on to global monetary policy, we've got some interesting information here from Capital Economics. So these are the pearls of wisdom from Neil Soaring at Capital Economics. First, and I quote, "There's not much that monetary policy can do to influence energy prices, since they are set in global markets. Second, while a rise in energy prices increases inflation in the short term, all other things being equal, the subsequent squeeze on real incomes is disinflationary over the medium term. The most likely outcome is for most major advanced economy central banks to proceed with the gradual tightening in monetary policy and to offer more open-ended guidance on interest rates." A little bit on monetary and fiscal policy from ECR. The view tends to mirror that of capital economics. Monetary policy. Bottom line is that higher interest rates slow down economic growth, and this depresses inflation. This means that interest rates can be raised correspondingly less if growth declines due to other reasons. This does indeed apply in the current situation.
Thank you, Nick. As you all know, I am Gielie, and I'm also based in the Overberg Greyton office. Let us look at what has happened in South Africa recently and the status of the JSE. Firstly, Anglo American announced that the value of rough diamond sales for De Beers in the second cycle of 2022 amounted to $650 million. That's very positive. Normally it's quite below 600, but that was a positive one. Stadio brought out figures yesterday morning. It was for the year ended the 31st of December 2021. The revenue increased from 933 million to just over R1 billion. So that was a special one for them. They've crossed R1 billion mark there with their revenue. The headlines earnings per share changed from a loss of 8 cents last year to a profit of 17 cents this year. Also very positive. The net asset value per share went up 10% from R1.78 to R1.95. And then to add to all the happiness and gladness, they will pay a final dividend this year, their maiden dividend, and that will be 4.7 cents in the rand per share, but the total value will be about 50 million rand. It's a big dividend. Motors Holdings said that Investec disposed of an interest in Motors such that the new holding is now 4.7% instead of 4.76%. It's a very small drop in the holdings there. And then just to say something about the story about Tencent, Naspers and Prosus, there was a massive sell-off triggered by regulatory pressures in Tencent, rumors of money laundering, rumors of non-compliance, and rumors of record fines. I've read what Standard Bank and FNB wrote about the issues, and their conclusions were very simple. They say they feel that the sell-off is overdone, and they think the three counters still have excellent long-term growth, but they expect it to be volatile over the short term. Prosus is currently trading at a discount of 31% to the underlying listed investments, and Naspers is trading at a discount of 54.6%. For the benefit of hindsight, it's just interesting that Prosus bought back millions of shares last year at billions of dollars. And that was, with the benefit of hindsight, a mistake. They overpaid for those shares. Those shares that they bought back is also halved in price. And then the foreign net buying of equities on the local market now stands at 23 billion year to date. Last year it was negative, so this is very positive. And that is all for me, Nick. Thank you very much.